Alright guys, welcome back to MMGinvest. In today's video, I will be talking about the state of the economy because it's looking bad. It's looking very bad fundamentally. And there's just a lot going on. There's so much going on right now. And I'm not going to do charts. I'll do charts at the end. In the beginning, let's just talk about the news. Alright. First of all, the Fed, Jerome Powell, Janet Yellen, and Ben Bernanke, they're going to go on 60 Minutes tomorrow. I'm going to cover that. I'm going to make a video about it. And they've never done that ever before. All right. So it's going to be a PR stunt. And there's a reason why they're doing that. And this is why. All right. So here is 18 big signs that the economy fundamentally is in decline. Like, we're about to hit excuse me, we're about to hit recession. It's not even recession. This is it. This is the big one that's coming. All right guys, so let's start. Farm loan delinquencies just hit the highest level that we have seen in 9 years. We just learned that the US exports declined by $4 billion during the month of December. That's huge. 4 billion with a B. JCPenney just announced that they will be closing another 24 stores. Victoria's Secret has just announced plans to close 53 stores. On Thursday, Gap announced that it will be closing 230 stores over the next 2 years. Payless Shoes. Source has declared bankruptcy and is closing all 2,100 stores. Tesla also closing all of their physical stores. Will only be online sales now. PepsiCo has started laying off workers and has committed to millions of dollars in severance pay. The Baltic Dry Index has dropped to the lowest level in more than 2 years. So the Baltic Dry Index is, I'd say, shipping between all of the Baltic region, right? North America, Europe. All right, this is the worst slump for core U.S. factory orders in 3 years. We just witnessed the largest decline in the Philly Fed Business Index in more than 7 years. January sales of existing homes fell 8.9% from a year earlier. 8.9%, that's huge. That was the third month in a row that we have seen a decline of at least 8%. This is an absolutely catastrophic trend for the real estate industry. Imagine 8%, 10%, month over month. I mean, that's almost 30% in the past 3 months that sales for existing homes has been falling. So the mortgage-backed security crisis, it's in full swing again, 2.0. U.S. housing starts were down 11.2% in December compared to the previous month. Compared to a year earlier, home sales in Southern California were down 17% in January. 17% 1 month. In December, home sales in Sacramento County fell a whopping 22.5% compared to a year earlier. So the housing bubble, a lot of it has been on the West Coast in California, especially San Francisco. So we're gonna, California, it's gonna be second world or third world in the next few years. You'll see. Pending home sales in the United States have now fallen on a year-over-year basis for 13 months in a row. 13 months in a row. Over a year of pending home sales have been falling. More than $166 billion in student loan debt is now seriously delinquent. That is an all-time high record. $166 billion. That's a lot of It's a lot of delinquent loans. The total student loan debt, I think it's around, I mean, don't quote me, $1.6 trillion total. So this is going to be on the rise, guys. I mean, nobody's paying their student loans. Most of these college students, they don't have real jobs with their arts degrees. All right, more than 7 million Americans are behind on their auto loan payments. 7 million, that's a lot of people. It is also a new all-time record and is far higher than anything that we witnessed during the last recession. So right now, as everyone keeps saying the economy is great, there are more auto loan delinquencies than ever before. I think in history. I don't know about history, but it's worse than 2008. It appears that the recovery has finally come to an end after seeing all those numbers. There is no way that anyone could possibly claim that the economic conditions are getting better. And even though the official government numbers are highly manipulated, we never have had one boom year throughout the entire recovery. So this recovery, guys, it's almost the longest recovery in U.S. history. And GDP growth has never gone over 3%. And I mean, honestly, guys, do you guys feel like this is a boom? Is it like the 1990s or the 50s? 1950s was the real boom, and the early 1930s. But it's looking bad. I'm not trying to scare anyone, but I am personally scared. I'm terrified because I know how bad this could get, and not just that, it's the fact that we may not see the economy recover in our lifetimes, meaning we might be poor for the rest of our lives after this bubble bursting. And that's just something you have to be mentally prepared for, and physically and financially. So yeah, not financial advice, but prepare for the worst, hope for the best. So let's look at a few more things here. The recent jobs report was the weakest in months. Here's why. I'll post these articles in the free chat group of MMGinvest. The links are below this video. China says working with U.S. day and night to get trade deal. China is in just as big trouble as the United States. It's actually worse because their debt to GDP is like, don't quote me, I think it's 260, maybe over 300% right now, because they have been printing money like it's going out of style, worse than the Federal Reserve in the past few years. So I will also post this article. I don't want to cover them. They're not that important. As budget deficit balloons, few in Washington seem to care. That is true. The trade deficit and the budget deficit, I mean, it's out of control. Out of control. There's no way to pay all of this off. This is why the bond market is going to implode along with the stock market. And we haven't seen that since 1930s Great Depression. And this time around is going to be worse. I mean, who's buying U.S. Treasuries? You're going to get negative return on investment. Why would you do that? So we've never seen outflows from the U.S. stock market like this since 2008 in the recent months, since the all-time high in the stock market. I will also post this in the room. I'm trying to get to the other article, which was really great. Fed's next move more likely to be a cut in interest rates. I agree. Because they to keep this market up and from crashing, that's what happens with a Ponzi scheme. You need more money coming in constantly than going out. And the way it works is you need more money and the velocity of money to increase with time, not decrease. And the Fed's been cutting rates since the last month since December 2016. So another jobs report, payroll employment rose a disappointing 20,000. And they're going to revise this down from it's probably going to go negative in a few months from now. And possibly by this summer, even mainstream media is going to have to admit we might be in a recession. I'll also post this. The Bls Job Statistics. I mean, guys, this is these aren't real numbers anyways. If you go to shadowstats.com, you will see the real numbers because they've changed how they do statistics, how the Fed does since the 1980s. So where is it? So here's the article. The U.S. consumer has just hit a brick wall. Now, this is why it's extremely important. One, the United States, it's a consumption-based country, empire. Its economy is solely dependent on people buying things. Things most people don't need, most people can't afford. And it's not based off of industrial growth and making things and selling it to the rest of the world. The United States became so rich and powerful because of the free market and the freedoms in the United States, which led to an industrial revolution, right, 100 years ago. And we built everything, you know, in the early 1900s, even up until like the 1950s. And we built everything for the world and we sold it to the world. And then we started seeing a decline after the 60s and 70s. We went off the gold standard in 1971, started printing money, and we are no longer a industrial-based society or country. We basically are a financialized economy based off of people buying crap and going into perpetual debt that is absolutely unsustainable. All right? So when it comes to the growth dynamo behind the global economy, nobody can match the U.S. consumer, not even China, accounting for trillions in annual spending. The U.S. consumer, who represents roughly 70% of the U.S. GDP, is also responsible for roughly 17% of global GDP, slightly ahead of the entire country of China. So the U.S. consumer, all the crap in the world that's being made, well, 17% of it goes straight to the U.S. consumer. A lot of it's probably coming from China. And it's actually larger, or about the same size as the entire economy of China, which has exploded in the past 20 years. And China is the second largest economy in the world, although some will argue it's the largest, and it might be the largest once the U.S. goes into a next recession. But you could also make the argument that China has been printing money, and their debt to GDP is past 260%. I think it's up in the 300 percentile now. And, you know, the ghost cities and the debt, and China's going down with the U.S. Who will survive better in the end? It actually might be China, because they actually still have an industrial base. And instead of taking all that money and shoving it into the stock market where it could go poof and disappear, they actually built infrastructure. Meanwhile, the U.S. can't even maintain its own roads and infrastructure that it's built up in the past 100 years. So, yeah, I mean, look at this. 17% of U.S. global GDP is U.S. consumer. Japan's only 6%. Germany's only 5%. Well, not their consumers. Their GDP as a whole for the country. The U.S. consumer, it's not the U.S. GDP. It's just the spending that the U.S. People do annually, right? U.S. government is at 4%. That's disgusting. Of global GDP, they're spending. By the way, that's going to disappear once the dollar is sacrificed. So this is why it's so scary. Let's continue. All right, so the Fed started hiking rates in December of 2016. Ever since they started hiking rates, big ticket purchase items like home furnishings, travel arrangements and reservation services, hotels, you know, rental cars, Also, used car dealers and their sales of used cars has been dropping. So big ticket items, your washing machine, refrigerator, home renovations, jet skis, RVs, all that crap, and cars and homes, it's been falling ever since the Fed started their tightening cycle of the interest rates, and the interest rates for everything, all loans, for everything in the entire economy, from your credit card to your home mortgage to your auto loans, right? So, yeah, they've popped their own bubble, essentially. That's what's pretty much has happened here. If you look at this chart, I can't really blow it up, so, but you guys get the idea. I will be posting the links in the free MMGinvest chat group. The links below the video. Credit conditions tightening, demands for consumer loans coming down. So consumer loans have been falling ever since, well, you could say they peaked out at about 2015, and they've been steadily dropping ever since the tightening cycle from the Fed. So credit cards, auto loans, and consumer loans for everything else. Credit card bills. Credit card interest rate, highest level since 2000 and, well, no, wow. Credit card interest rate at highest levels in decades. I mean, decades. Since, not even 1995. So we've surpassed 1995 high interest rates for credit cards. And this is because of the tightening cycle from the Fed. Now, Citigroup almost went under in 2008. That's a big lender, right? Big bank. A lot of their revenue comes from credit cards. And the credit card companies are not stupid. They're trying to cash in as much as they can before the next recession or depression, whatever's coming. And so they stay alive, but it's probably too late. Yeah, people, the U.S. consumer, you guys have to understand, inflation has been running, according to the Fed, at average 2% annually. I argue that it's much higher. It's probably more around 4-5%. And you could do a simple test. You could take the average cost of Thanksgiving dinner from year over year, and that's actually been going up. Meanwhile, so inflation's going up. The average person's pay is not going up, or it's not keeping up in pace with inflation of annually like 5%. So even if we take the Fed's numbers, right, their statistics, which they've changed since the 80s. If you go to shadowstats.com, they give you the real numbers. And they changed it on purpose so the public doesn't realize that inflation is much higher than it is. They don't take into account like utilities and the food you buy, right? So 2%. So in 10 years, inflation runs 2%. So in 10 years, you have lost, I mean, but this is compounded, right? But at the end of 10 years, it's like 20% pay cut. So if your pay if you haven't gotten a raise of 20% in the past 10 years, you've pretty much lost 20% of your pay due to inflation. If that makes sense. So the cost of living is rising and rising. That's why it's harder to live. That's why you don't have any discretionary spending money, and that's why you're living paycheck to paycheck. Because the ultimate tax is that hidden tax of inflation. And it's a tax because the money goes to the banks, the stock market, and then to the government because they tax the stock market and all these monopoly corporations, right? That's the tale of how they rob you, slowly but surely. And people have to, they start maxing out their credit cards during Christmas, during emergencies, and they don't have any savings left. There's stats out there that an average American has less than like $1,000. It's like around $700 in their savings. And that's because, I mean, inflation, right? And not just that, high-paying jobs are just going away. They are. It's the truth. Everything's getting automated, algorithms. Before you know it, 5 years from now, there'll be robots doing manual labor because they don't have to be paid health care or anything like that. But, you know, the left promises all these social programs. Believe me, the companies will just automate, and no one's going to have a job. So you're not going to get any of that anyways. And then there's no way to pay for it anyways, so... Auto loan interest rates increased by 2 percentage points. So the interest rates on your auto loans are starting to really take off, especially in the past 6 months. 2018, it's really started, and that's because the Fed kept raising interest rates. And now we see auto loan delinquencies at a record highs. Household interest payments rising 15% year over year. So imagine this. Everyone since like 2009 who's been buying homes, they got these great deals, right? Low interest rates. So they bought homes they really couldn't afford because the price of these homes was still higher than they're really worth, because the Fed came in and bailed out the housing market and bought up like billions of billions, hundreds of billions worth of home equity loans after the MBS crisis, and that was Ben Bernanke, right? And but they suckered in everyone, especially millennials, to buy homes in the past 10 years. And now the interest rates on these home loans are starting to skyrocket because the Federal Reserve started raising interest rates since 2016. You can see, if you look closely, it started skyrocketing December of 2016 when the Fed started raising interest rates. It went from, I don't know, like 1% all the way to 15% now. Now, these people have been refinancing their homes and taking money out of their equity and buying cars probably and things, you know, that they still can't afford. And now the interest rate on those home loan mortgages are starting to skyrocket. And now they're discretionary, so they have no money left after their paychecks because now they have to service the home mortgage and the interest rate. And, you know, a lot of these people, once they can't even pay the interest rates that keep skyrocketing on their home loans, what do you think is going to happen? They're going to foreclose on their homes, and it's going to be the mortgage-backed security crisis 2.0 all over again. Except this time around, it's not going to be just homes. It's going to be auto loans. It's going to be everything, credit cards. It's going to be people are going to lose their jobs because corporations have been doing stock buybacks and artificially pumping their stock prices, and they haven't been reinvesting in their businesses. And I just named off the 18. There's going to be massive layoffs. I mean, we already see it in the retail sector. It's the retail apocalypse. Why do you think there's a retail apocalypse? You can't just blame it on Amazon. It's writing's on the wall, guys. The trend in interest payments as a share of household spending is worrying. So as interest payments go up, share of household spending goes down. I just said that. Downside risk to car sales. Car sales ever since 2016, when the Fed started raising interest rates, has been plummeting. The car bubble, I mean, it's popping, guys. I've been talking about that for like 5 years. I've been posting on my Instagram. Current conditions for buying vehicles and houses by top 33% household income tercile. Everything's just imploding. Retail sales point downside risk to consumer spending. Yeah, obviously the consumer doesn't have extra money to go buy clothes and Payless shoes, so Payless just went bankrupt. Open-end loans, number of delinquent bank card credit loans. So credit card loans, they're starting to go delinquent. And it started right after 2016. Really started skyrocketing at the end of 2017. More delinquent direct auto loans. Yes, it's been on the rise since 2015, and it's trending up, and the trend is your friend. So it's gonna be a great time to buy a car. So this is what I'm doing, right? I have physical metals. I also have stocks. As my stocks start going into like the stratosphere and I'm making like 1,000% gains, you know, I could go out and buy a new car. I've been needing a new car for a few years now, and I'm just holding off. I'm gonna go buy a Raptor or something at like a 50% discount to today's prices. The credit cycle is leading the economic cycle. Economic slowdown risk is rising. This is very important. The credit cycle is leading the economic cycle. This is what Keynesian economics does. It turns the economy into a Ponzi scheme based off of credit. And credit has to constantly expand. And when the expansion stalls, then you get these huge bubble bursts. Because credit, what it does is it creates bubbles. And I've talked about that. You guys, I think, understand that. Credit cards. Millennials facing more financial challenges. Yeah, because, you know, they're doing arts and they're getting arts degrees and social justice warrior degrees. And they're not teaching them about how to use debt. There's only like 1% of the population that knows how to use debt to their advantage, and those are the entrepreneurs. The only time you should take on debt is when you're building a business that has a high likelihood of actually succeeding and bringing in more money, and you could pay off your debt. And there's no other reason to get debt. Maybe for homes, but you shouldn't be financing cars, shouldn't be financing anything besides maybe a home and a business. That's it. Every credit for everything else is just trouble. Because most people can't keep up with inflation. Do you understand? And you know, I don't want to get into it. Decline recently in domestic business sentiment. Yeah, it should be in decline. I mean, a lot of companies are missing revenue earnings. So, guys, the writing's on the wall. I'm scared. And now's the time to get your shit together. Mentally, financially, physically. People are going to be violent when shit hits the fan. I mean, Americans, no idea what's coming. They have no idea what the hard times are. And, it's scary. All right, come to MMGinvest.com where you can save yourself. I'm trying to save everyone with myself. This is what I'm doing. It's not financial advice, but I've done some research on mining stocks. And here's the video. You click on it. I'll give you a sneak peek preview of what the report looks like and what will be in it. And the product pays for itself. It's not overpriced. Believe me, there's other reports, not even half as good as mine, and they cost more. And you could also do an affiliate program, right? So you could sign up as an affiliate. It takes 2 minutes. You get 33% commissions. I've never seen a commission that high, and you'll get $100 per person that actually buys the report when they use your referral link. And you could actually this is lucrative. You could actually make a lot of money if you know marketing. Or if you have a large following and you're listening to me, like you have your own YouTube or something, and you share this, I mean, you're probably going to make a lot. So, there you go. I said I was going to show the charts. You know what? I'm going to make a separate video tomorrow with the charts. And, because I don't want to make it too long of a video. Gold, it had a nice rally, nice bounce, and I do want to see the 60 minutes interview, and then I possibly will do the charts, and I'll upload that for Monday morning prior to the opening bell for the markets, or I might upload it late night, Sunday, my TA analysis, because it's tricky right now, guys. All right, it's tricky, but listen. Not financial advice, but what I'm doing is I'm dollar cost averaging in and buying more mining stocks. I don't think you could go wrong by doing that right now. So I'll talk more about that in a separate video. Until next time, guys, smash that like, share my videos, please. I really appreciate it. And leave in the comment sections your thoughts and opinions, and I do read them and I will answer them. Alright, guys, until next time.